Hey everyone, welcome to just a quick podcast here. Going through kind of following up on a lot of my past videos on how to like pre-screen deals or do like preliminary underwriting. I think it's essential when you're getting into deals to have kind of a buy box, I would say, as far as like your criteria, the markets you invest in, the type of deal profile, the asset class, etc. So I'm just going to be walking through just a quick kind of rundown. And since like the last time I recorded like an episode on this, I've since kind of like edited that spreadsheet, like the deal tracking spreadsheet. And it allows just for more refined uh, uh, stats, such as like stabilized NOI, um, understanding like aspects such as like the rent bumps that you're projecting, the business plan that you're trying to execute. So I'm just going to be walking through that. And if you're tuning in on Apple Podcasts or Spotify, that's great. So I'll kind of be more like explanatory as far as like the ins and outs of how to pre-screen deals. But the people that are watching on YouTube, it might be just easier to follow along because I'm just going to be screen sharing um, that spreadsheet. Um, so yeah, this is essential. I think for any type of investor to just keep, and every single deal that they analyze, it's great to have this because you can see all the spreads across different markets. You can filter out accordingly the deal profiles, or I guess the average capex for that particular project. So this is essential to have for any investor, and I highly recommend just kind of like you can uh, get a deal tracking spreadsheet through like a investment firm, or you can just make this yourself. I had the pleasure of borrowing this from Lone Star Capital. They're an investment firm in the Dallas, Texas region. And I saw like tremendous value in this, so that's why I've been using it. But yeah, this is it probably takes like 10 to 15 minutes to just like plug in all these numbers and see like if the deal works out just on the front end. And then if it is like a market that you're attracted to, you've been researching it for a while, the spread looks good, it might be a wise idea to dig deeper into that T12 or rent roll and underwrite it thoroughly. So, um, yeah, I'm just going to be overviewing what it is that I added to this, and how it kind of allows for more refined uh, metrics within your underwriting. So, as you're starting off, obviously you're going to get the type of deal that you're going for. And within that, you see here, I have it like core, core plus, and then every single letter after that is just like that class type. So within core, it's probably just going to be A or A plus. Core plus, probably like B plus to A minus. Uh, Light value add could be like B, B plus. Value add could be within like the C plus to B range. And then heavy value add is anything from like C minus to um uh I would say C minus to C plus in that range. And then for opportunistic, it's like pretty much like either completely restructuring, demolition plus ground up development. It kind of adds a little different layer and more complexity into this, but that's the deal profile that you want to track. um and kind of just stepping back a little bit, so the one way to kind of filter out your deal flow, for instance, the types of groups that you sign up for like email subscriptions from brokerage platforms sending you the listings, or also on like other public listing platforms like Zillow, Realtor.com, or LoopNet. All of those different platforms, you want to make sure that your strategy and your uh, investment type is defined right off the bat. So many have just like kind of like filters that you can screen it down towards, but I'd be very kind of like selective on like the asset class. I would specialize in one asset class, and then some alternatives I would probably keep as like a passive route, to maybe just vetting like other companies that have more experience in it. They're more vertically integrated. It's better to learn from those companies before actually getting into one of those deals. So the asset class that I'm obviously more focused on is multifamily, but it could be according to your preference. So if you have more experience in industrial, you've done more research in that sector, you're probably underwriting more industrial deals, right? So it kind of depends on the investor's preference, but that's the first thing that you want to define off the bat. And then the style of the property. So if you're more a value add investor, you're probably ranging from like C to all the way up to like B plus deals, right? You're probably not targeting core plus deals that much. You may dabble in some light value adds, maybe bringing like a B or B plus up to an A minus or a market level. But you're not really getting into stabilized deals that have already gone through lease up, have done the renovation program. It's pretty much kind of a management play at that point, right? So with value add, you're really going in with a mentality of how many units can we turn, how many rent bumps can we get from that, and then also you're starting to build out your your team, right? So your focus, it's a team oriented space to invest in. So you're talking with general contractors, property managers, you're obtaining data from them, starting to get like if they have like a few projects that they did in the past, maybe getting some capex budget items from them, and then you're starting to kind of solidify elements in that market, like the average price of a roof replacement, HVAC, plumbers, electricians, right? So all of those people are going to help your deal out and maintain your deal for a long period of time, right? So those are aspects within value add that you're targeting. And you're also just looking at the distress level of the property. So obviously this is going to depend on your condition report that the lender is probably going to require this, but essentially you're looking at what you can, the major capex items that you can renovate within that stabilization period. And you're also looking at the style of the units. Are they outdated? Cabinetry, countertops, flooring, like popcorn ceilings, right? These are all outdated items that could be replaced and you can realize better rents from them. So that's kind of like the mindset and value add. But and then the other aspect is just unit count, right? So are you more of a small to medium sized investor? So then you're going to target deals that are in the I would say like 5 to 50 unit range, right? If you're medium sized to larger investor, you've already kind of had some deals under your belt and you're trying to scale at this point, you're starting to get into the more higher unit counts. So what I've kind of started, some have been kind of like a range, and that's something I also need to work on is kind of playing in one specific space, like the 5 to 50 unit space, or deals that I know can have potential, and not really targeting deals that aren't going to really work out, or I don't have the capacity to take on a project like that, right? So you can also see here that some spreads for the yield on cost to market cap rate, some are negative because those deals didn't work out for me, right? So and this is probably the best way to just like understand markets, understand the deal profiles, the spreads, and then ultimately starting to establish connections off of that, right? So yeah, and as you're kind of going through this, these are all the necessary items that the spreadsheet kind of has that you can just plug in. So obviously the unit count, the year of construction, that gives you a good idea as far as like when the last period it was that it got renovated. So whether it's like a 1960 build and then it probably got renovated like in the early 2000s, then you have a good idea as far as like how many things you might need to replace, right? So yeah, but essentially square footage, then you'll get some stats once you input like the ask price and then the bid price, right? So this is the pricing guidance that the broker or the seller's agent is going to give you, and then your investor value, that's something that you're trying to achieve. And then as you can see here, this is just a discount tracker. So basically seeing what the difference or the discount that you can get on a property. So for instance, this one was asking around like 16.7 mil, and then my valuation came in at 12.5. So it's like a 25% discount, right? So this is how you can kind of track the goal. Like you can establish a goal that, hey, we want to get into this deal at like a 15-20% discount, since it is like a distressed asset, or it's kind of outdated, and we can go in with our value add plan and realize a better valuation after, right? So this is pretty much everyone says that the most of the money is made on the buy, and then the refinance, and then the sell, right? So the periods in between those three specific periods, that's where the most work has to go in, and that's where you really need to kind of hone in on your management and your operations to bring out the best of that property. But as we're kind of going through this, I'll also just show you what I've been working on to kind of add to this, just because it's wise to get down to more refined numbers. So as we're going through this, I'll just show you basically how you can get down to a stabilized NOI. So many people base the NOI either off the OM, or maybe like they're trying to grow NOI by like 20%, 30% within their value add period. And then that's it, you know. But to get a more refined figure, you're really basing it off of the rent increase that you get from those unit turns, right? So as you're kind of going through this, this is like the equation that I did. So essentially the percent of units that are needed to be renovated, the current average rents for those units, the average rent increase that you're getting across the bedroom type. So it doesn't matter, like let's say that it's like a 50 unit building, and it's comprised of like 2 beds and 1 beds. Let's say 2 beds make up 30 of the units, and 1 beds are 20. And you're only going in renovating like 80% of that, right? So all you need to do is just average out the rent increases that you get for the 1 beds and the 2 beds after they've been completely remodeled and they're good to go. You average that out, and that's your average rent increase. And then this PGR, which is your potential gross revenue, that's basically taking, so it's an equation here. So basically, you're taking the current average rents, you're adding your rent increase, you're multiplying it by 12 since it's on a monthly basis, but then you're multiplying it by that percentage of the units that you're renovating. And then you're adding back the units that are unrenovated, and you're just getting the same rents that were before, right? So that's how you calculate your PGR. And then other aspects you need to input to get down to your NOI. So your economic vacancy, so that's including loss to lease, physical vacancy, bad debt, delinquent rents, all of that. So those losses you need to account for. They'll probably be in the T12, so you can just take a look quickly and see what that is. If it's on a percentage basis, like let's say the T12 like wasn't provided, and then on the OM they had like a percentage that they gave to those items, then you want to add up all of those and see what the total top line revenue losses would be. And then lastly, or the last 2 things, other income. So that's how much income they're getting from application fees, lease fees, parking garage fees, all the necessary fees that are in a normal apartment building. So yeah, and then as you get down to your projected OpEx, so basically this is a goal that you want to have, right? So your OpEx is obviously it's a ratio. So the OpEx ratio is your total operating expenses divided by your effective gross revenue. So what I did here is it's just adding or summing up these 3 numbers. Obviously, you have to subtract out economic vacancy, but adding back other income, and that'll get you to your effective gross revenue. So once you get to that, you want to keep a goal. Like, let's say the T12 came back and operating expense ratio is at like 50%, right? And you're trying to decrease that by 40% by implementing better outside contractors, vendors, getting better pricing on some service contracts, right? And decreasing that operating expense by 10%. So this is a goal that you want to keep before getting into the deal, that's saying, hey, we have a strict budget for 40% of our operating expenses. And we want to maintain that, right? So that's a good goal to keep, and that'll give you a good idea as far as your operating expenses during that period. Obviously, for the value add portion of it, and especially during lease up, you might have some additional costs, right? But this is more of a long-term look, like in year 2, 3, 4, what do we want our operating expenses to be averaging out to, right? So that's the operating expense. And then after you kind of sum up all of those, you get down to your NOI. So the NOI is just a basic calculation of all of those numbers. So yeah, and then CapEx, this is another topic that many people have and questions on, and how do I kind of like go about my preliminary CapEx budgeting, you know? So what I do is across the deal type, I have a particular dollar per square foot that I budget for. So for instance, Core Plus, not going to have that much CapEx, right? And I'm sorry you can't see the equations here, because I'm trying to like take out like the actual deals, because I don't want to break like confidentiality. But basically what it is I'm just giving a dollar per square foot for each one. So for Core, it could be pretty low, maybe like $2 to $3 per square foot, right? Core Plus, maybe a little bit higher, $4 or $5 per square foot. And then the value add portion is ranging anywhere from like $6 all the way up to $10 per square foot. Or for instance, this project right here, I realized that it was a resort. I mean, not a resort, it was a motel, right? So they were portraying it as a multifamily investment, but it was actually a motel. The average square foot per unit was like 200, 300 square feet. That's not livable for multifamily standards, right? So you really have to go in there. You have to restructure. You have to break down units. And they were offering in their OM saying that it's a 68 unit deal, and it's like 17,000 square feet. That's just not feasible, right? So you need to go in there. You need to combine units. You need to do a lot of restructuring, and there's a lot more CapEx involved. So what I did here is that here I said it requires redevelopment from hotel units to multifamily. And then a good target would be 700 square feet per unit, and which means combining units, restructuring the cost, right? So what I budgeted for was $30,000 per unit in restructuring costs, and then on top of that, $7 per square foot for like FF&E, which is furniture, fixtures, equipments, and the interior finishes on the units. And then additionally, I also did $3 per square foot for the exterior upgrades. So that's one way to kind of really get down to the and this is a placeholder, honestly, for CapEx. This is literally just like pre-screening deals. You're not really going into it too heavily. So this is okay. This is just a quick little thing that you can do. And once you kind of get into the deal and you underwrite it thoroughly, and you start to conversate with your network, your contractors, your property managers, you start to get some rough quotes. Then you can start plugging those numbers into your underwriting and seeing the exact returns that are calculated, right? So this is just a kind of a little like precursor of getting into the deals, but it's still good to look at, because what I'm going to get to as the ultimate point is just seeing that spread between the yield on cost and the market cap rate. But anyways, so that's what I did here quickly for this particular property. Other ones, I just give kind of like a dollar per square foot for the interiors and the exteriors. And then I just go on to the next portion of this spreadsheet. So that's how you define your capex. And then ultimately, this is where that cap rate yield on cost spread is calculated. So there's three different methods. So there's the underwritten cap rate from the seller according to guidance, and then the yield on costs from that, and also the spread on that. So I wouldn't really look at this too much, just because it's not really what the investor or is looking at, and you're not really concerned with that. You're more concerned with your investor's underwritten cap rate and the spread, and then also the spread between the market cap rate, right? So basically your underwritten cap rate is it should be just your current NOI that like is from the T12, which is a good thing to look at, because that's a good indicator of where you can go with that property, right? So if the NOI is pretty good, like it's performing well, and but it's still lacking, like let's say below market rents, there's some deferred maintenance, there's some unrenovated units, you can go in there and realize better valuation, right? Then there's some opportunity there to grow NOI, right? But ultimately it's just your so the underwritten cap rate for the investor is just your current NOI divided by the investor's value. So yeah, and then the yield on cost obviously is going to take your stabilized NOI and divide that by the investor's value plus your capex budget. So that gives you your investor yield on cost. And then you're just seeing a spread between there. If it's sizable, that's a good sign, right? And according to deal type as well, you're going to have different spreads. So for core and core plus, could probably be from like 50 to 100 basis points. For value add, like whether it's anywhere from like light value add to heavy value add, could be in the range of like 100 to 175 basis points. And then opportunistic, since you're really just going in and you're bringing up like pretty much everything, like you're stabilizing the asset to its maximum, that's going to have the most return potential and the highest spreads. So opportunistic, I would say 200 basis points plus. So that's just a good kind of scorecard to keep for those deal types. And then lastly, the market cap rate, right? So then the big question would be like, where do you get market cap rate data? And that's a struggle that I have, but it's still good to just rely on sources that are out there. But the ones that I use are National Association, sorry, I'm stumbling. National Association of Realtors, CRE reports. So they have like these commercial real estate reports that they post, and within that they have like a market cap rate figure. And I can actually show you that. So for instance, right here, this is in North Carolina. So this is what it's called. So it's just commercial real estate metro market reports, right? So essentially it goes into each asset class. It goes into some cool stats here, honestly, like absorption units in the last 12 months, asking rent growth in the last 12 months, the average rents in that market, and then vacancy rates, market cap rate. But the main thing I was just looking at is just market cap rate, just observing that. So that's one source I use. Another source would be RealPage. So RealPage posts reports pretty regularly. I can give you just one report here. Let's just stay on the topic of Carolina. So Carolinas, this is the second quarter report. So basically they go into this, each submarket or major market, they have like a cap rate here that they assign to that. So this is based off of their data. So could be biased, but again, they have a lot of people that use their platform. They have a lot of data that they're getting. So it's actually more defined than you actually think. So Fayetteville, like all these different markets, Wilmington, Asheville, markets that I don't even have that much like background in, honestly. For Carolina, the ones that I'm really concerned with are Charleston, Raleigh, Durham, and Charlotte at this moment. So basically, this is a good report where you can get some average cap rate data, and you can utilize that in your underwriting. And then lastly would just be brokerage reports. So for instance, CBRE, they post a semi-annual cap rate survey where they pretty much go through each and every asset class, the infill versus the suburban deals, and they're just tracking cap rates across the class types too. So like class A or class B, like, so they're giving different cap rates accordingly to the deal profile. So that's another source that I also use. So but anyways, you should always update this because cap rates are constantly changing. So it's a good idea to, whenever like new reports come out, just keep updating this so that you can get more defined figures. And what I do is literally I just go to the market, whatever it may be. I filter it out and just change the cap rates for each of those markets. So pretty simple. And it also helps that when you're more defined in like one or two markets, it just makes things a lot easier, updating a lot easier, and you don't really have to worry about getting your head spun in different directions, different like fundamentals and various markets. So it's really good to just define your focus in a few markets. So yeah. And then once you've kind of like underwritten the deal and you've kind of gone through that process, it's okay to just put the projected IRR and the unlevered IRR here so that you can track the average IRRs per like deal type. So at the end of this spreadsheet, it's pretty much like a total summary. Where'd it go? Crap. Okay. Yeah, so this is just like a total or average summary at the bottom here, so you can see how deals are kind of performing, the ones that you've underwritten. So yeah, I hope this video was helpful. There are like more components that you can get into, but again, this is literally your pre-screening deals, but it allows for you to just filter out all the different noise that is out there, all these different offerings that are getting sent to you, and it just allows for a more kind of defined focus as far as your investment philosophy. So yeah, thank you guys for watching. Hopefully this was helpful. Feel free to share this podcast, helps out a lot. And again, thank you for watching. Oh, actually, before I end this, this is another topic that I just wanted to touch on. So investor value is another thing. So this is kind of a little bit interesting. How do you define your investor value? So I mean, obviously, like the guidance, whatever the pricing guidance that is going to be sent to you according to the broker, you're targeting a discount, right? So whether it's a 10%, 15% discount, you're targeting a discount based off of the deal profile. But you also want to see like how that market performs, like according to the average multifamily property in that market, right? So for instance, I use Census Bureau for just like average home values or owner occupied housing units. It's probably not the most accurate thing to use, but it just gives me a good idea as far as like what the average unit price is in that market. And then I use that sometimes. Other times I just use like whatever the current NOI is, and just divide that by the market cap rate in that market, right? So for instance, this is just a quick calculation I'll just do right here, but for instance, this NOI right here is 120K, and it's at a 4.3 cap rate in that market. So what I would do is just I'd take the NOI, divide it by that cap rate, and okay, it's in percentage. I need to change that. Actually, let me just do this in another tab here, and like let me just do it in a dollar tab. Okay, so basically just take that current NOI. Again, this is current NOI because you're basing it off of whatever the current seller's financials are, and using that as negotiation power to say that, hey, we're in this particular percentage cap rate market, and the NOI is this, and this is honestly just a quick valuation that I came up with, right? But anyways, so as you do that, you'll see here that the value is like 2.791, and I came in at 2.448 because according to the deal profile, I thought I should buy it at a 15% discount, but that's what the value is, right? And then you see another one here at 744 NOI, and their valuation was 16 million, right? And if I just take that market cap rate, I will find that it's valued at 14 million, right? So you could base it off of that and just kind of give yourself like a ceiling that, hey, I'm not going to pay more than this price, but I still want to get it at a little bit of a discount below that. And just keep that as kind of like a buffer zone where you can kind of negotiate the price. So that's like one tactic that I just saw. But anyways, this is just like a quick video on how to pre-screen deals, filter down your investment strategy, and ultimately get like a handful of deals rather than a needle in a haystack. I've probably said that before, but that's essentially what you're doing through this process. But yeah, thank you guys for watching. Hopefully you enjoyed, and feel free to like, comment, share, and stay tuned for more. Thank you.